Today, folks, as we've been discussing my Canadian stock portfolio, this question has arose quite a bit, fairly common. Anyone noticed that VDY paid less dividends this month? And it's not even just this month. The overall dividend has actually been declining in this ETF. And I want to explain to you why that is, as it's promoted as this kind of monthly paying Canadian high dividend yield ETF. And this might not actually be a good dividend income ETF for those in retirement, those looking for steady, stable income. And I'm going to break down why, while also answering another question in tandem here, as someone asked, if you hold individual Canadian stocks, would you sell at these crazy highs and buy into VDY or keep riding the long-term dividend train? I'm talking banks, REITs, energy, and this question is great as well, and it'll really kind of fall in line with what I want to discuss between all these Canadian dividend ETFs that I like, and hopefully one will kind of match what you're trying to achieve in the market. But if you're on a path to financial independence, if you one day want to retire early, join me on that journey. Hit that subscribe button. Of course, this is not financial advice, but over a decade of investing, I hope I can give you a little bit of insight here. Now, firstly, when it comes to looking at the markets at all-time highs, and the Canadian markets have absolutely crushed, they've outpaced the United States, but you got to recognize there's a lot going on in the economy today. I mean, we're seeing record high commodity prices, precious metals, and that's driving and bolstering a sector that is huge here in Canada. On top of that, guys, we have AI, this onslaught of efficiencies and margin expansion, and you can call it a bubble, but we don't know where this leads to. And I mean, people could have said the dot-com bubble was just some fairy tale fantasy that got overextended. Yes, it did in the short term, but long term, the value was coming. And it's hard to tell right now where we're at in the cycle, if this is truly a bubble or if we're going to see valuations continue to catch up. And I can't predict that. So what I do, and what everyone that I know got rich did, is just cost average. Always be buying in the market. Buy the highs, buy the lows. You're going to end up with the best median price, knowing that over a 20-year period, the markets have never lost money, and we've been in a 15-year historic bull run, right? So I would say most individual investors that buy individual stocks eventually become ETF investors. I don't think there's, and this is somebody that, again, used to be purely individual stocks. I don't think somebody can individually properly manage 10, 20, 30 stocks in a portfolio and understand all the industries and sectors and how to weight it correctly. So I always feel like a lot of people end up coming down to this conclusion, which is, should I just sell my individual stocks and buy into an ETF? And my conclusion is always yes. It's always great finding an ETF that matches your goals, that holds the stocks you like, so you have a one stock to buy solution to the entire sector economy that you're looking to invest in. So let's talk about VDY here real quick and talk about the different ETFs that I think you would personally like that might match your needs. And we'll start with VDY and why it might not be the best ETF for you. As somebody that's 33 years old, I'm focused on total returns. I've always been, guys. I'm telling you, like, I like promoting dividends. You guys like listening to dividends, but as somebody that's this young, it doesn't make sense for me as much as it might for my parents who are in retirement, right? And VDY has done exceptionally well this year, but you have to understand that it is a market cap weighted ETF. And when you go into market cap weighted ETFs, it means dividends are not necessarily the focus. So we're going to come take a look at the spreadsheet and the holdings in here in a moment. But if we just read the objective here, basically it seeks to track the performance of the FTSE Canadian High Dividend Yield Index to the extent possible and before fees and expenses. It employs a passively managed, fully replicated index strategy to provide exposure of Canadian large, mid, and small cap stocks diversified across all industries, and uses efficient, cost-effective index management techniques. I am a boglehead. I love ETFs that use market cap weighted, passively managed systems. What that means is that basically it's going to take these dividend stocks off certain criteria, but in the index, it's going to look at them all and weight them. So like the percentage of the holding is weighted to the one next to it based on the valuation of the company and the size. So if we look at the top three holdings, Royal Bank, Toronto Dominion, these two alone make up 25% of the entire ETF. 15% Royal Bank, and almost 10% Toronto Dominion, and then you got Enbridge down here just below 8%. But if we look at the value of these companies, Royal Bank is trading at almost a $300 billion value. TD is trading at almost a $200 billion value, and Enbridge is sitting at around 150. So you can see the scale in these stocks are dramatically different, and this ETF is going to weight them based on that valuation to the one next to it. So what ends up naturally happening is it doesn't matter about the dividend yield, right? So if the stocks that start performing the best and start getting a bigger and bigger value, they will naturally work their way up this ETF. And if those stocks don't pay a higher dividend yield, guess what? The overall yield of this ETF will likely decline over time. And I mean, we see it, right? Like some of the highest paying dividend stocks stocks like TELUS, companies like Bell is not performing well. And if the market cap keeps getting smaller and smaller, guess what? It's going to get a smaller weighting in this overall ETF. So if we look at the dividend, which we just got another one yesterday, that dividend was just over 14 cents, like it was 14 and a half cents or whatever. So we can see that 14 cents now for this. And again, because most of these companies pay quarterly, there's going to be some choppy nature to how these get paid. But regardless, 14 cents is pretty low. The last time we saw 14 cents, guys, I mean, you'd have to go all the way back to where? Where was the last time we saw 14 cents? I mean, back in 2023, 2022 even. So a lot of people are getting kind of concerned and worried about this. But the reality is if the dividend is going down, it's likely because stocks are expanding and the ETF as a whole is growing at a much higher pace. And again, that's the reality of passively weighted ETFs. The dividends are going to be unreliable, probably a lot less steady. But the reality is that the market's doing exceptionally well and these stocks start to grow much quicker, means the dividend's probably going to be getting smaller, but the overall growth and total return is going to be higher. And we've talked about this relentlessly because VDY has since inception annualized around 11%, which is phenomenal. I mean, those returns are nothing short of astonishing, right? So let's compare it to something that I would consider a more foundational ETF, perhaps for somebody looking for income that might not be as total return oriented. I'm still going to say this, even if you're in retirement, total returns matter. You should always look at the total return, but can skew more toward income oriented, more stabilized income ETFs if you're leaning in that direction. And I think XEI is a good foundational stock for something like this. You'll notice that if we just take a look firstly at the returns here, they're not nearly as high. I mean, 8.2%, it's not terrible, but it's nowhere near close to the 11% we've been getting out of VDY, but we're going to get more stability and more diversity that comes with that, and likely a higher yield. 12-month trailings at just under 5%. Same expense ratio at 0.2% as discussed, but we can see no one stock in this ETF makes up more than 5%, which means it's going to be an individually managed ETF. And if we actually look at the goals here, it's to pay monthly dividend income at a low cost and designed to be a long-term foundational hold, and seeks the long-term capital growth by replicating the performance of the S&P TSX Composite High Dividend Index, net the expenses. So it's not employing a passively weighted system here, right? So we can see if you go through all the holdings, you're going to see stocks in here like Bell and TELUS, but they're not going to be reweighted based on their stock performance like VDY is. So you're not going to get the same total returns, but hey, you're still going to be locking in a much more higher yield. It does pay monthly, and that monthly yield is likely going to be more sustainable and more consistent over time, right? Which is exactly what we see if we look at the dividend distributions coming out of this. The only other ETF that I think kind of blends both these worlds together, but again, comes back to the point of being hand managed. This isn't passively weighted. It's not some just automatic mechanism based on market caps and non-emotional way of investing. These are, again, managed ETFs, but I think XDIV can also serve a pretty good purpose. And let's just say, like, look at XDIV's up, what? I mean, almost 16% year to date. VDY or XEI is up 15.9%, and VDY is up 17.7%. All of these have performed exceptionally well, but as you can see over time, I always find passively weighted indexes always just inch out those bit of extra returns and do quite better. But regardless, I'm not saying these are bad ETFs. XDIV has done exceptionally well and has actually since inception annualized a very similar return of 11.6%, and arguably, comes with a lower fee at 0.1%. Yeah, the trailing 12 month is just a little bit higher than VDY at around 4%. And if we take a look, you can see that the top weighted stocks here, Toronto Dominion, Sun Life, Manulife, Royal Bank, these are all weighted at just under 10%, 9%, but there's not as many holdings as XEI. There's a little less there's less holdings of VDY and XEI. It's not nearly as diverse as those two ETFs, but it's kind of core focusing what it considers to be the more value, stable, dividend, larger market cap dividend stocks. So, a little more concentrated than XEI, a little less concentrated than VDY. And if we read here, it says it's the low-cost portfolio of Canadian stocks with above-average dividend yields and steady and/or increasing dividends. Select securities with strong overall financials, including balance sheets and less volatile earnings. So you can see that they're changing their criteria based on certain factors and designed to be a long-term core holding, and obviously seeks to provide long-term capital growth by replicating the performance of the MSCI Canadian High Dividend Yield 10% security capped index net expenses. So these are the three ETFs that I think you can employ into your either retirement strategy, or if you're younger like me and you want Canadian exposure but you want more growth from the dividend side of things, VDY I think is exceptional. But again, you got to ask yourself, like, what do you require? Because if I was investing like this guy asking this question here, I don't know what your exposure is, like your time horizon, what you're trying to achieve. But the reality is VDY is very concentrated, and I wouldn't make it like a huge position because I just don't want to be over leveraged in two stocks. Like, I mean, if you put 100 grand in here, guys, 15,000, 25,000 of it is just going to two companies. So if this was your entire portfolio, that might be a bit excessive. And again, if you're in retirement, however, you might want more stabilized dividends, and you can maybe pair something like XEI with XDIV and get the best of both worlds, some concentration in more stocks that pay good higher yields, but also get more diversity through XEI. Again, you can mix and match these how you please, but that's why VDY is not paying a very stabilized yield. I mean, let's just take a look at the yield for XDIV. You can see it's actually been going up quite more consistently, way more consistent dividend over time. So, I mean, if you're looking for pure consistency with a bit of growth tapped in, hey, maybe XDIV might be the best solution for you to the Canadian economy. But I'm going to leave that up to you. Again, these are dividend focused. These are not total market ETFs. I'm going to remind you that as well. A lot of people don't realize that, you're not getting exposure to the other Canadian stocks out there, like the railways, like the technology companies. I've picked these ETFs for me for very specified reasons of what I want to achieve out of the Canadian economy. So VCE, you can see here, is outperforming even that of VDY right now, guys. So you might want just a broader Canadian index ETF. And I want to leave that on the table as well for somebody that might not want to be as delved into this and trying to do what I'm doing, because I have nothing against just buying VCE. And a matter of fact, if you buy something like XEQT, a total market ETF, guys, when you're buying and getting Canadian exposure through this ETF, you're getting the total Canadian market. So this is why XEQT might be a good end-all be-all solution. It doesn't have to be XEQT. You might find some other global market ETFs that work for you, but this is how I'm getting more exposure to the Canadian economy, by starting to inch in XEQT into my portfolio as well. But again, I hope this kind of just gave you the full picture and gave you some opinions and, just my perspective on the markets to answer those questions. But I'll pass it off to you. I'd love to know how you're managing your Canadian side of your portfolio in that comment section below.